Hi traders, it's Zoran Kresovic here from Eightcap, head of sales for APAC region. Another week in paradise, that's what I like to call it. Obviously, quite a bit going on this week. For the trade zone, a lot of market news, a lot of different charts actually playing in different directions. But I guess first thing that I would like to start today is with a bit of a recap or debrief on last week. So from last week, obviously, we had the Fed interest rate decision to somewhat expected, which is what I actually discussed and mentioned at the time. 5.25 is the interest rate in US at the moment, and obviously Fed actually kept it on hold. So it's a bit of a wait and see scenario. Highly likely they will probably rate another 25 basis points in the month of July. But nevertheless, the rates were actually held on hold. And as a result, obviously, US dollar somewhat actually depreciated after that news announcement. Also, we've had the ECB, European Central Bank as well. Last week, I touched on Euro. Euro, I did actually say on Wednesday that Euro was probably likely to appreciate, given the fact that 25 basis points with ECB was already kind of factored in, and it was just a matter whether Fed will surprise the market with 25 basis points in the US or not. Because it didn't happen, obviously US dollar depreciated, Euro appreciated, and it looks like Euro might be going towards the next resistance level. And should you wish to actually check out the podcast or the webinar last week, then please just jump on Eightcap YouTube channel and you'll be able to see the analysis there. So that's pretty much in a nutshell last week. This week, obviously, we've got another interest rate decision, and this week we are actually putting a little bit of focus on pound. So inflation is running quite hot in UK at the moment. We've got the CPI data, and obviously we've got the interest rate Bank of England meeting on Thursday. So that's probably the key takeaway for the week. Aside from that, close to home here locally, we've got the People's Bank of China interest rate decision, which is actually happening tomorrow. That's going to play a big role in terms of what I want to talk to today and in general, because Chinese economy is actually being somewhat subdued. It's been lagging behind at the moment, even though obviously post-COVID things have opened up, but there is a bit of a contraction in the Chinese economy. So Chinese government is actually pretty reluctant to actually stimulate the economy in terms of the fiscal policy, and they actually looking to basically issue more bonds on the market in order to prop up the actual economy and potentially Chinese yuan. So tomorrow's interest rate from China is going to be super important. Previously sitting at 3.65%, the terminal rate, and it's very interesting to see actually. There is no forecast whether it will change or not. There is potentially a good chance they might cut the rates by 25 basis points, taking the terminal rate to 3.4% in order obviously to stimulate the economy and basically get it going, because the output production is been actually fairly low in the China, and it is actually it is affecting the rest of the globe because China is one of the major powerhouses in terms of the economy. Also locally here in AU, if you are watching the Aussie USD, there was another analysis that I've done last week, and it's played out nicely. Aussie is broken through the 68 handle mark, and it's actually marching upwards since the interest rate decision to actually lift the rates a couple of weeks ago. So Aussie is on a strong trajectory to the upside at the moment, and tomorrow will be interesting to actually watch the RBA meeting minutes. That's going to be super important and probably as equivalently important as the interest rate decision a couple of weeks ago. And the reason for that is quite simple. We expect another 2 rate rises in Australia. So we expect the Reserve Bank of Australia to lift at least another 2 times 25 basis points in the month of July and August, because Reserve Bank of Australia is actually behind the yield curve. So it is behind the curve in terms of the interest rate rises against the rest of the governments and banks around the globe. So watch that space if you're trading Aussie USD. Also, we've got Fed Williams speech on Wednesday. We've got Bank of Japan monetary policy. Japan yen has been getting absolutely smashed at the moment, and obviously the negative rates held on hold. The short-term rates were actually at negative 0.1 last week. If you're doing a carry trading is one of those important topics at the moment, because if you're looking actually buying the high yielding interest rate currencies against and offsetting that against the low yielding interest rate currencies, then Japanese yen and Swiss franc are those currencies that you would actually hold as a negative yielding currency. And obviously, generally, the way it actually plays out, we can see a lot of strength in the USD versus the yen at the moment. Or if you have a look at an Aussie versus the yen, or if you have a look at the pound versus the yen, it looks like actually big players out there are actually doing or taking into account a lot of carry trade at the moment, and as a result, all the major currencies against the yen are appreciating quite strongly in a steep upward channel. So that's happening on Wednesday if you're interested in some of that. And then obviously Fed Chair Powell testifies on Thursday. That's going to be an important one as well. Okay. And then we've also got the RBA interest rate, Bank of England interest rate decision as well in terms of the UK. So the market is factoring in another 25 basis point interest rate rise. CPI data is around 8.5 to 8.7% on yearly level at the moment. So it's actually raining, it's actually quite strong. So it's quite high if you compare it to the some other countries around the globe. So it's highly likely that a Bank of England is actually got room for at least one, if not more than that, in terms of the rate rises. So market is already kind of starting to factor in that 25 basis points. So that's in terms of the macro news. How about we actually get started in terms of the charts now? And I always like to start with this one because it gives me a bit of a sentiment in terms of, where US dollar is going against the majors. So I did mention for the last couple of weeks, always a good starting point. And if you have a look at it, that long-term downtrend line from the actual September in 2022 is still actually quite valid. And as I mentioned over the last couple of weeks, we can see that it's provided a strong resistance here around the 103 to 104 mark. Obviously, US dollar did not manage to break that. It's actually bounced off and, hover over under it, I should say. And it seems like actually sellers came in and absolutely squeezing the short side of US dollar at the moment. It's probably to somewhat expected. And I would expect something like that to occur in the current market, especially given the fact that Fed obviously didn't lift the rates. I think in terms of the US dollar, we needed that 25 basis point upside in order for the US dollar to actually break the downtrend line and move towards that 105 level mark, and potentially, if it was to break the resistance, to move into that 107 or 108 level. So that is the upside resistance on US dollar versus the majors. Now, what do I expect over the next few weeks? Well, it will be data dependent. But I will say I wouldn't be surprised to actually see US dollar weakness, at least in the short term, to be honest, and to come back and actually retest that $100 handle mark. That is a multi-year support level on the chart. It's been providing a lot of support back in April and May, obviously back in February 2023, and then even further if you actually go back to May and June in 2022. So very, very strong level on the chart. Also, something else to actually note here is RSI is obviously hovering more to the downside, which could say that US dollar is being actually oversold a little bit. but nevertheless, I would also put a lot more focus on the actual price as opposed to the indicator itself. But something interesting to note is actually this downtrend line and this support level. We are coming into this zone here, which is actually quite interesting because if you have a look at it, it's actually kind of getting squeezed in. So the way it normally works is the more support and the more trend we get in play, and once we come into those squeeze zones, which is what we would be actually doing over the next few weeks, generally speaking, when the actual market or the chart goes in a narrow range, which is what is going on here now, then normally the more explosive the moves, because it seems like the price would actually contract for a longer period of time, and the more in narrow it goes, the bigger the moves outside of those zones. So something to actually take into account and something to actually pay close attention to when it comes to the USD, US dollar versus the basket of major currency pairs. I will actually for this week push away from the currencies. I just actually gave a bit of a overview. My pure focus this week will be equities, because equities is a huge talking point here at the moment at Eightcap, or in general when we actually talk to our clients. So how about we actually get started on S&P 500, and I will cover ASX200 as well. I will also cover DAX as well, just to make sure. So S&P 500 is actually broken through a major resistance level at 4,000 to 178 level, and it's actually marching towards the upside of 4,500. 4,500 is actually a very significant resistance level on the mark, because it's actually a nice round number. And to be honest, given the fact what's happening over the last week or so, given that Fed is actually put the rates on hold, there could be more upside to the actual equities in general. Obviously, the tech sector in US is absolutely dominating right now. And fun fact, actually, top 7 to 10 tech stocks in S&P 500 are actually driving the majority of the market. And the reason for that is because they've got the biggest market capitalization. So the market weighted index is heavily on those 10 stocks, and as a result, the other 490 stocks, they're probably nowhere near in terms of the market cap, and as a result, obviously these 7 or 10 stocks are actually pushing the market upwards. Now the question is, will this continue, or will these stocks actually have a breather and pull back? Well, if you have a look at the Nasdaq is absolutely smashing it at the moment as well, and it's actually reaching its all-time high levels. We might get a bit of a breather as well, but for the last week, S&P has actually gained 2.6%. So because we've got the elevated US dollar weakness and top, tech sector being the top clear performer, with Microsoft hitting the all-time highs, it's hard to be actually really bearish on the equities at the moment. So at least for another few weeks until we see, further decision making from the big governments. But S&P, if you have a look at the seasonality as well, so if you have a look at the period of last 5 years in terms of the seasonality performance per month, July and August, coming into the July and August, have been actually very successful. So for example, S&P in the month of July for the past 5 years has actually gained approximately 2.67%, which is a punchy move. And also for the month of August, it's been approximately 2.42%. So risk on at the moment. RSI, 14-day RSI is way above in the $80 zone, and indicates that this could be overbought a little bit. I wouldn't be surprised to actually see a bit of a downside, at least short-term downside in terms of the breather. On S&P 500, this is a nice uptrend line that I've got here. So I wouldn't be surprised to actually see a bit of a pullback to that $4,300 level mark. But, I'm still quite bullish, or we are bullish on equities at the moment, because it seems like medium to long-term trend is actually on the upside. So S&P 500, if it was to come to 4,300 level, this uptrend line would actually provide a nice support level. There is also a lot of demand zone in the blue boxes, and also coincides nicely with the actual support level of $4,178, which provided a resistance level in the past as well. So quite a nice, healthy chart of S&P 500. As I mentioned previously, NASDAQ is heavily driven by the tech sector, absolutely smashing and outperforming the market as well. So as long as these tech stocks are actually doing quite well, then obviously, general market sentiment in the US actually should continue on the upside. The next chart that I would like to actually go to is the ASX. So I've got ASX chart here. This is purely ASX200 stocks. So from what we can see here, I started this on daily basis or daily chart, just to actually paint a bit of a picture for you. We've got a resistance level at around $7,600 mark. That's probably a more of a longer term resistance. And we've got the base support around $7,000 mark. So that's pretty much, in terms of the ASX 200 at the moment. And, the ASX has been actually hovering kind of on a sideways, slightly bullish, but more of a sideways trajectory all the way since, 29th of March 2023 upside. The uptrend obviously topped up on the 17th of April, and since 17th of April 2023 till 13th of June, we've seen more downside on ASX 200. We can see a downtrend line as well from that high back in 17th of April 2023. That's been actually playing nicely as well on the downside as well. And the blue line obviously here provides actually a high demand zone as well, where looks like the actually buyers have come in and tried to take actually price from those lower levels. Obviously, their break up, happened on Friday. That obviously was coinciding nicely with Fed not raising the rates, and they will actually take a step by step over the next month or so. Whilst market is actually factoring in another 25 basis point interest rate rise in the US. Obviously, it will depend on data-driven decisions, and same with the RBA here locally as well. So tomorrow's minutes will actually pave a picture as well, a little bit more on the actual ASX as well. Absolutely. So if you have a look at the ride on Friday or the up bar, there was actually clear breakout of the downtrend line, and today we can also see that buyers are absolutely dominating the market right now. So, let's have a look in a closer picture. What could be the upside from here onwards? So Fibonacci retracement, if we apply Fibonacci retracement, it's broken through the 50% zone. So from this high I've applied in April back to the actual low in 31st of May, we can see that that's broken through the 50%, which indicates further strength in Aussie 200, and it's probably likely to continue to actually test the 7,400 level marks. Now that's probably a short-term resistance at the moment, and in terms of the upside, let's have a look at from here. So we are looking approximately of 1.06%. So that's probably a short-term upside on ASX 200. If you're looking at the actual downside itself from these levels, and to come back and retest that downtrend line that was broken, we are probably looking at 1.6% to the downside. So obviously, as I always mention on these webinars and when I speak to clients, it's about the risk reward that one trader is actually willing to take from here in order to actually trade the market. So ASX, obviously also quite a lot of news as well from the ASX, because closer to China, it will be important to see post COVID stimulus package. So that's actually going to be an important one. obviously the interest rate decision as well tomorrow, whether they're going to drop that. If they drop that, they're going to stimulate the economy as well, which means basically being an exporting nation, Australia, they should actually play a big part in terms of the ASX200, but not only that, in terms of the Aussie as well. For the past week, last week, ASX actually climbed 1.1%, and that was purely on the basis of energy sector. Energy sector rallied 3.5%, and that was actually on the back of the surge in crude oil. So that was actually the biggest driver for Friday and Monday. The last chart that I would like to have a look at now is actually German DAX. DAX is an interesting one, and I'll start off on weekly chart so you can actually have a look at the bigger picture. Right now, DAX is actually hitting pretty much an all-time high, and it's actually hitting that resistance level. Generally speaking, if any product, whether it's whether you're trading shares, whether you're trading, commodities, FX, etc., if something is hitting an all-time high and it breaks that, then generally speaking, that would be considered a bullish move. And now, if you have a look at it back from the lows in October 2022, we can see DAX has been absolute outperformer. It's been smashing to the upside, and the uptrend is actually clear uptrend in play here. So if you go from the lows all the way up and use this as an uptrend line, but also as a support level, we can see the DAX actually from those levels back in October last year has gained 38%. That's a very, very punchy move. That's actually very, very significant. So if someone, bought off those bottoms, then, they would be laughing right now. But let's have a look at the actual chart on daily basis now. I will also apply the Fibonacci level from these lows here to the actual most recent highs. And I will also apply Fibonacci level from the last major range as well. So from the low on 30th of May to the actual high on 16th of June. So if you have a look at that, we can clearly see that, there is a coincide with 50% of the last range, which actually obviously coincides nicely with 23.6% of the bigger range. So that's a nice confluence there in terms of the price. So if DAX was actually to not break the current resistance levels and it was actually come back to test it, we would expect it to come into the range of 15,950 to probably $16,000 level mark. That would be probably some sort of support. Also, it coincides nicely with the actual supply and demand zones, because we can actually see a lot of congestion here around demand for this for the actual index itself. So if the price was actually to continue and come back to that, we could potentially expect buyers to come back and buy at a discounted price. If the price was actually to break these levels, then the next level probably likely in place would be the $17,000 mark. So 17,000 is actually a nice round number, and DAX could actually, there is a chance that it could push to those levels. Now, in terms of the upside, if you're looking at percentage-wise from these levels, we would be looking at another 4.74%. So we'd be looking at close to 5% upside on DAX. If we take that into the account with the other 37.83 or 38%, we are looking at pretty much in 7-8 months 40 to 43% return on DAX. That's very, very substantial. That's very, very good return on investment. Now, I do understand, obviously, traders love to pick the tops and bottoms, and not always it works out in the favor. But even if you're getting the middle bit, the middle of 60%, out of that move, you'd be still actually doing quite well. So that's pretty much it for this week. Obviously, reviewed, just to bit of a debrief, S&P 500. We've looked at the ASX200, and we've also looked at the DAX 30 as well, German 30 index as well. all these indexes are combined out of all the stocks that are within the exchange. So, DAX 30 is made out of top 30, German stocks. ASX200 is made out of top 200 ASX shares, and then S&P is actually made out of all the top 500 S&P stocks on the actual exchange as well. So a clear uptrend in play, medium, short term, and to some extent long-term uptrends on indexes at the moment. It will be interesting to see where we go over the next few weeks, because it will be a lot of fundamentally dependent on the governments across the globe and what they're pointing out in terms of the actual inflation. But nevertheless, if you're riding the trends and you got your long positions or whatever your strategy is, then so be it. Wish you guys all the best, happy trading, and we shall touch base on Wednesday to see how we actually monitoring from here onwards. Enjoy the rest of your week. Thank you.